Hey everyone, and welcome back to the channel. If you're new here, we are all about making your money work for you. So, let's talk about the future, specifically 2026. It might feel far away, but if you want to start investing, the best time to prepare is right now. Today, I'm going to break down exactly how to get started with investing as a beginner, step by step, with a clear plan for 2026. No jargon, no confusion, just a straightforward guide to help you build wealth. First things first, let us tackle the biggest myth out there, that you need a ton of money to start investing. That's just not true anymore. You can start with as little as $5 or $10. The most important thing isn't how much you start with, but that you actually start. The power of compounding, where your earnings start earning their own money, is like a snowball rolling down a hill. The earlier you start it rolling, the bigger it gets over time. So, forget about waiting until you're rich to invest. You invest to become rich. Alright, before you put a single dollar into the market, we need to get your financial house in order. Think of this as building a solid foundation for your investing skyscraper. Step 1 is creating a simple budget. You need to know where your money is going. Track your income and expenses for a month. Use an app, a spreadsheet, whatever works for you. The goal is to find out how much you can comfortably set aside to invest each month, even if it's a small amount. This isn't about cutting out all the fun. It's about being intentional with your spending. Next up, a crucial safety net, your emergency fund. This is money set aside for life's unexpected curveballs, a car repair, a medical bill, you name it. The rule of thumb is to have 3 to 6 months worth of living expenses saved in a high-yield savings account. Why a savings account? Because it's safe and easily accessible. You don't want to be forced to sell your investments at a bad time just because your car broke down. This fund is your peace of mind, allowing you to invest with confidence. Now, let's talk about debt, specifically high-interest debt like credit card balances. The interest rates on these can be crippling, often over 20%. No investment can reliably guarantee that kind of return. So, before you go all in on investing, it's usually a smart move to pay down that high-interest debt. Think of it as a guaranteed return on your money. Paying off a 22% credit card is like earning a 22% return. It's a huge financial win. Okay, foundation built. Now for the fun part, defining your why. Why do you want to invest? Is it for retirement? A down payment on a house in a few years? To travel the world? Your investment goals will determine your strategy. Goals can be short-term, like saving for a vacation next year, or long-term, like retiring in 30 years. Write them down. Be specific. A clear goal like I want to have $20,000 for a house down payment in 5 years is much more powerful than just I want to make money. This why will keep you motivated when the market gets a little shaky. With your goals in mind, we can talk about risk tolerance. This sounds complicated, but it's just about how comfortable you are with the ups and downs of the market. Generally, if you have a long time horizon, like for retirement, you can afford to take on more risk because you have time to recover from any downturns. If your goal is short-term, you'll want to be more conservative. Be honest with yourself. If the thought of your investment value dropping 10% makes you want to panic sell, you probably have a lower risk tolerance, and that's perfectly okay. There's a strategy for everyone. Now we are ready to open an investment account. For most beginners, a brokerage account is what you'll need. Think of it as a bank account for your investments. There are many great options out there: Fidelity, Vanguard, Charles Schwab, and newer app-based platforms like Robinhood or M1 Finance. When choosing, look for low or no fees, no account minimums, and a user-friendly interface. Do a little research, read some reviews, and pick one that feels right for you. The process to open an account is usually quick and can be done entirely online. Once your account is open, what should you actually invest in? As a beginner, you don't need to get fancy and try to pick the next big stock. One of the best and most recommended strategies is to invest in low-cost index funds or ETFs. An ETF, or exchange-traded fund, is like a basket that holds hundreds or even thousands of different stocks or bonds. For example, an S&P 500 index fund lets you own a tiny piece of the 500 largest companies in the US. This automatically diversifies your investment. You're not betting on a single company, but on the growth of the overall economy. It's a simple, effective, and proven strategy for long-term growth. Let's dive a little deeper into that. Popular ETFs to look into are ones that track the total stock market, like VTI or the S&P 500, like VOO or SPY. By buying just one of these, you're instantly diversified across the entire market. It's the ultimate set it and forget it strategy for beginners. You avoid the stress of trying to pick individual winners and instead just ride the wave of the market's long-term upward trend. History has shown this is a winning strategy. So, how do you actually put your money in? The key is consistency. A powerful technique is called dollar-cost averaging. This just means investing a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When the market is down, your $100 buys more shares. When the market is up, it buys fewer. Over time, this averages out your purchase price and reduces the risk of investing a large sum at a market peak. Most brokerage platforms let you set up automatic transfers and investments, so you can put your strategy on autopilot. This is how you build wealth systematically. Now, let's fast forward to 2026. You've been consistently investing. What should you be doing? The most important thing is, not much. Seriously. The worst mistake investors make is reacting emotionally to market news. The market will go up, and it will go down. That's normal. Don't check your portfolio every day. Don't panic and sell when the headlines are scary. Remember your long-term goals. Your job is to stick to your plan. Keep investing your set amount, month in and month out. Trust the process. This disciplined, patient approach is what separates successful investors from everyone else. Once a year, it's a good idea to do a quick check-in. This is not about overhauling your strategy, but about making small adjustments. Has your income changed? Maybe you can invest a little more. Have your goals shifted? Perhaps you need to adjust your risk level. This is also a good time to rebalance your portfolio if needed, which just means bringing your investments back to their original target allocation. But for the most part, staying the course is the name of the game. To recap the plan for 2026, start now by building your financial foundation, budget, emergency fund, and pay down high-interest debt. Define your why by setting clear, specific investment goals. Open a low-fee brokerage account. Start investing consistently, even small amounts, into low-cost index funds or ETFs using dollar-cost averaging. And most importantly, stay disciplined, ignore the noise, and trust your long-term plan. Investing isn't a get-rich-quick scheme. It's a proven path to building long-term wealth. You have the knowledge now. The next step is to take action. Thank you so much for watching. I hope this guide helps you feel confident and excited to start your investing journey. If you found this video helpful, please give it a thumbs up and subscribe for more content to help you master your money. Let me know in the comments if you have any questions or what topic you'd like me to cover next. Until then, happy investing.